Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. The last few weeks we've been covering macroeconomics. It's time to delve straight into real estate. What are the current market concerns that real estate investors have? And more importantly, what can you do about it? Our amazing guest will make some great points and share some awesome ideas today on the Real Estate Guys radio program.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me in the co-host seat, it is our financial strategist, Russell Gray.
Hey, Robert.
It is so hard to keep up. There is so much going on, not just in real estate, although that's true, but just the economic markets and the banking and all the things we've been talking about the last few weeks. And it's been tough as a Real Estate Guys listener because we've been talking broader picture economics for week after week after week. And we thought it was past time to talk true and center real estate. So the good news is that's what we're going to do. The bad news is there's some challenges in the real estate market and in financing and in commercial and maybe even multifamily. So there's plenty to talk about.
Well, the logical sequence as an investor is to look at the big picture, the context, the market. We talk all the time about the market being not just the geography, although that's important. And real estate's local. So you got to pay attention to what's going on in the local market and what those local dynamics are. People moving in, people moving out. Is it business friendly? Are jobs being created? Are jobs being lost? What kind of jobs are being created? Do they pay right? What type of demographic is there? That's the second type of market. Who's the demographic? Your product niche could be different. Student housing is certainly different than senior housing, which is different than affordable housing, which is different than Airbnb, short-term rental. So they're all different niches. That is a market. So it's geographic market, it's demographic market, and then it's product niche. And when you look at where you're going to deploy your capital and how you're going to structure your deal from a financing perspective, you got to pay attention to macro factors like the availability of credit, the cost of credit, the terms of the loan, the underwriting criteria, the loan to value, and then the overall trends in your niche and your demographic and your geography and also in interest rates. So people say real estate investing is simple. I think it is simple mechanically. The difficult part is the context in making good decisions about those structures, those markets, and how you're going to approach the business. Talk all the time about what happened in 2008. I was ignorant of the macro, just plugging along in the trenches, buying real estate, highly leveraged, very dependent upon healthy credit markets. The world blew up. I told myself, hey, I lost everything, but nobody could have seen it coming. And then I looked around and I said, you know what? There are people who are actually making a fortune in this exact same market. So guess what? It's not the market, it's me. And I got to figure out what am I thinking that's wrong, which is causing me to act wrong, which is producing bad results, because what you believe and what you think affects what you do, and what you do affects the results you produce. And there's a couple of people that we started paying attention to that we became good friends with over the last 15 years, and we're going to get a chance to talk to one of those guys today.
I think the big message is that as markets change and as the underlying fundamentals shift, you have to change. We have to bob and weave and move and pivot when the market changes. And however long you've been in real estate, if it's been 5 years or 10 years or 30 years, determines your perspective. Our guest has been in the real estate markets for a long, long time. So he's seen up and down and high and low and expensive interest rates and cheap interest rates, and has been able to navigate successfully through those times. And that's what it takes. When you hear the news today, and I know it's heating up because twice last week, NTD Business News asked me to be on the program, once to talk about the commercial markets and what's happening there, which we'll pick our guest's brain on, and once to talk about housing and what's happening there. So times are heating up when the national news is covering real estate more and more. The big question is, what does the future hold? And what do you do about it? We can back, you're going to meet one of our favorite real estate guys, best-selling author Ken McElroy with us today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
For thousands of years of human history, silver has been recognized as money. Then in 1965, the United States took silver out of the financial system. But did silver stop being money? Smart investors don't think so. And ever since, when there are concerns about the quality of the currency, alert investors seek shelter in silver and gold. As the size and frequency of major financial crises grow, silver is attracting a lot of attention. To help better understand the what, why, and how of silver, watch the free 9-part series, Making Sense of Silver. Everything you always wanted to know about silver but didn't know to ask. Featuring 30-year precious metals veteran Dana Samuelson. Send your email requests to silverseries@realestateguysradio.com. Whether you own silver now or you're wondering if it's too late, email silverseries@realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, this is Mauricio Raul, founder and CEO of Muir Law Group, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Now in our 27th year of broadcast, we're talking about real estate and the markets and how they change. And our guest is no stranger to change. He's seen all kinds of real estate markets over his time in the business. Please welcome back to the Real Estate Guys radio program, our good friend Ken McElroy. Hey, Kenny.
Hey, guys. How's it going, man? Always good seeing you, too.
So good to hang out with you. Thanks for coming out to the last Secrets of Successful Syndication. That was a hoot. We had a good time, and you really shared some of the things I'd like to get into today there. And it just was evident, this time that you've spent in the markets. You can read about markets, you can have an intellectual understanding, but you have something we call seat knowledge, right? From being in the saddle. And it was interesting, we were talking about interest rates, and everyone's all freaked out that interest rates are higher than they've been in 10 years. But Ken, for most of your career, interest rates have been about where they are now.
Well, I think if you look over the last 20 years, you'll see that I think the average is somewhere around 6. So, we just, by the way, rate locked on something last week at 5.2. And, we're doing a lot of cash in refis and we're just refinancing anything that we have variable for sure. So we can hedge whatever the Fed might do next, which is, again, something that we had to learn. But regardless of that, I think, people forget that we just came out of this incredible time frame with really, really, really cheap money. And that's what created a lot of the bubbles. That's all that's happening. And some people are in denial. How could this bubble go down? But those of us who have been around a little bit are just saying, well, this is part of the process, part of the cycle. And I think Russ said it really nicely in the beginning in the intro. What do you see now? Like, there's a lot of ways to make money right now, a lot actually, in real estate, but not if you just know one thing, like I did when I got my real estate license. It was a single family house. That was the extent of my wisdom. And then from there you branch out and you start to realize that it's not one big category. There's a lot of things going on. There's a lot you can do.
Well, you've already said a couple of golden nuggets, which is typical Ken McElroy form. If you listen too quickly, it goes right by. But the fact that you guys are taking variable loans, and a lot of us got into variable loans when the math said to do so, but you're recognizing that now's a time that we might want to shore that up and get some fixed rate financing, but that comes with the price. And you mentioned a cash in refi. And if folks aren't familiar with that term, we're used to cash out.
Yeah.
Yeah, my equity's gone up and I want to redo the loan. I want to take some money out. This is the opposite of that. Can you speak to why now is the time you have to consider a cash in?
Yeah, I think it's probably best that I just give an exact example. So we have one property that we actually built 10 years ago. It's drop dead gorgeous. But 10 years ago, it's a bit dated, the carpets, the appliances, that kind of stuff. And so we looked and we said, oh, if we upgrade it, it's gonna, we're gonna get a few $100 more per month per unit. So that was all there was. So we went, did a refi, cash out refi at the time, took a little bit of that money and set it aside to do renovations. Very common practice, on something that you've owned a while, even something that you may have just bought. Well, the market's changed since then. Even though we're renovating, we're getting the rents. The expenses aren't that much different. That's the irony. The property's performing like we said it would. The only variable is the interest rate.
Yeah.
So the interest rates have been going up, and therefore our monthly payment has been going up because it was variable. And the reason that you're variable at that point, as a lot of people might be thinking, why didn't you fix it then? Because you want a variable rate so that you can get all the work done, and then you go in and put permanent debt on there. That permanent debt has a big prepayment penalty, and so you're solving toward that prepayment penalty. That's why you have a variable, because you don't want to have to pay that when you're stabilized, I guess is the way to say it. So anyway, so in this particular case, our mortgage payment is $250,000 a year higher. A year. So we're like, okay, this isn't good, because rates have gone up and your mortgage payments have gone up. At the same token, we went and said, okay, what's the property worth today? Just like you would on any other type of scenario. And they said, well, we think it's worth X, but here's the bad news. You have to come up with $980,000 in order to finance this project.
Wow.
So we know we got 250 negative from where we thought we were going to be. So that's over a year, that's $1 million. And then, or over 4 years, sorry, that's $1 million. And we got 980 on a cash in. So we decided, let's spend $1 million of cash, refinance, hedge our number at 5.2. And then that will also generate another 250 a year in cash flow, or 20,000 a month. So call it a 4-year payback on cash that we had.
Yep.
So that's a scenario of you hedging your debt, knowing the certainty of what that debt's going to be in year 2, 3, 4, 5, 6, 7. Also, if rates go down, which everybody is saying that they're going to go down, and I hope they're all correct, then you can also refinance again and go the other direction. But what we've done is we've hedged our upside. So that's a cash in.
Well, and you have to make different lending decisions based on the environment. And a lot of folks in the last couple of years have been in variable rate product, and some of them don't have the $980,000 to change that. So let's talk a little bit about what we see on the horizon. This is the thing I was talking about on the news the other day, that there's $1.5 trillion of financing out there that's coming due in the next few years. And you brought up a really good point, Ken. That is, when you finance an apartment building, it's not like your house where you could just refi the next year. There's the lender that commits to the time frame, whether that's 5 years or 10 years, however long the term is. And there can be substantial prepayment penalties if you want to get out of that early. So what normally facilitates the need for a refinance is that timeline. Hey, the loan's coming due. We're going to have to do something. And I know in your career, there's been many times where the situation of financing when you bought the property is not the same as when you go to refinance the property. Sometimes you decide to sell because of that. Sometimes you get a better loan because of it. And sometimes you don't. In the past year or so, we've seen people take advantage of bridge debt for that reason and purchasing insurance in the form of rate caps. Can you talk about what that has done to the market and to the underlying assets as we look at the months ahead?
Yeah, so there's a lot to unpack there. The first one is a rate cap itself is basically insurance policy. It literally is a cap on the rate. In every single scenario, because we have been here before, we bought rate caps. And we checked on this one. Our rate cap, by the way, which we have, was only 25 grand.
That's cheap
at the time. Now the funny thing is people are like, that there's people, I already actually know some of those people have said, why do I need a rate cap? We don't need just 25 grand, like rates are low. Well, we buy rate caps on everything. That same rate cap, listen to this, in order to renew the rate cap, $1 million.
Wow.
So we went from a $25,000 hedge. Now rates are higher than the rate cap, but we hit the cap, and that cap is at 20 grand more per month. But it's $1 million. So we're like, well, why would we do that? Why would we just do a cash in for the same amount, basically? And then we have a 4-year payback. We get our money back in 4 years. So I think there's a bunch of things happening with people. Anybody who bought anything with variable debt, which is most people the last couple of years, that didn't buy a rate cap, they're hitting the wall right now. They're out of money. They're going to their limited partners. They're trying to figure out how to keep these deals. I'm actually seeing those deals through our investment committee. So they're quietly being shopped, some not so quietly, but they're trying to sell. They're trying to do whatever they can to sell this property. And as you know, the waterfall, the way the funds work is the debt first, equity second. So we're seeing in many cases, equity's gone. Because, what happens is as a buyer, I'm now buying that same property at, say, 5.5% debt, whereas they actually originally, when they started, was probably closer to 3%. So the difference in the debt costs are making a big difference in the value of the asset. That's really the big lesson. And so that's driving commercial costs down because cap rates have gone up. As interest rates have gone up, cap rates have gone up. So the crazy thing is that the people who bought those properties actually are performing. That's the interesting thing. The net operating income and all the stuff that we teach, how to grow that number, they're doing it. We're seeing positive rent growth. We're seeing rent growth inside of a rent roll, on a value add strategy. That stuff is still happening. So even on our own portfolio, the difference is the rate. What that means is we're seeing at least a 20 to 30% discount. So imagine that if you bought something that's $50 million and 20% of that is $10 million. So that means it's worth $40 million. So you buy it for 50, hoping it's going to go up to maybe 60 through some kind of value add, but it's really valued, all things being equal, about 20% less.
Well, and to your point there, imagine that you bought that with 20% down and the loan was that same 40 million. Now all that's left is the loan. As you mentioned, the equity is wiped out at that point, unless the operator can continue to make the payments through the rent and through tenant acquisition and those things and hang on to play another day.
That's 100% correct. So, and that's what a lot of people are doing. So, we're all hoping rates go down because all of a sudden that brings all that value back. But the game is if your loan's maturing or you have a rate cap, let's say maturing, or your loan's maturing, or your debt or equity's maturing, you're in trouble unless you have that cash. And so I can't tell you how many times we look at a deal in the last 2 months, and basically Ross and I both say, well, the LP money is gone. They don't even know it yet.
Right.
Now, that if they have to sell, it's gone. But there's a lot that can happen in the next 2 or 3 years. So it's not necessarily gone unless there's a forced exit of some sort. If it's a sale, it's gone. If it's a cash out refi, it's gone. And so to your point, when you got asked to speak, I read an article yesterday, and I'm actually trying to verify the validity of it all, but it was a very credible magazine. Commercial Real Estate said that there's $2 trillion of commercial debt expiring in the next 2 years, half of the commercial debt. So one of the questions I asked Ross this morning was, how much commercial debt does our bank hold?
Yeah.
Because that's the bigger issue for me. I was like, if they're, again, using that same scenario, everybody's looking at these bank failures and the deposits and the bond prices and stuff, and that's important to look at. But the real issue, I think, is if that bank is carrying a lot of commercial debt and they're now faced with, that syndicator not being, it doesn't matter if it's office or retail or multifamily, they don't care. They just have commercial debt sitting out there. The office buildings are really the one that are the most in trouble. So when the person says, here, you can have this office building back, Mr. Banker or Mrs. Banker, that is when you start to see that work through those banks. So that's I think the tsunami hitting the shore at some point is that commercial debt.
Well, and of course, everyone's asking, is there going to be opportunity after this? And I think we would answer, there's always opportunity. But to your point, sometimes the opportunity comes early. Like right now, you guys are seeing deals that aren't in trouble yet, but the principals are smart enough to say, hey, we see this coming. Then we're going to see people that are blindsided by it. And then we're going to have the ostrich syndrome, folks who know they're in trouble and don't say anything to their LPs, and that's going to get ugly. We've already seen a little of that starting to manifest. So there's definitely challenge. But let's, I think, segue over to commercial a little bit, even though I know you own a office building or two. We've had a lot of that in our portfolio over time. The big thing with office is the financing, just like in apartments, is for long periods of time, 5 and 10 years. So my premise, and what I mentioned on the newscast the other day, is there are lots of properties right now that have in-place financing, office properties that are empty or 25% full, but the company is able to make the lease payment, and therefore the owner is able to make the mortgage payment, so it doesn't look distressed in any way. But you and I know that when that lease comes up for renegotiation, at the very least, they're going to renegotiate the rate based on all the empty space, or they're going to move. They might not even need the space, or certainly not all the space, and all of a sudden, what was a performing property becomes a distressed property.
Yeah, I had a gentleman on my podcast that I wanted on there because he's a commercial office expert doing leases in San Francisco. I was like, okay, what's happening there? Because how can Elon Musk lay off 80% of his staff? And, they're all over San Francisco area and other places, of course, but not just picking on Twitter, but, just other businesses. And he said that he estimates that, most of downtown is somewhere between 30, possibly even higher vacant.
Yeah.
So you guys and we all know that's not sustainable. That's actually where your profit is. So you basically got three things. You've got your operating expenses and your debt payment, right? And then after that is your cash flow. Well, the cash flow, there is none at 70% occupancy.
Right.
So now you're eating into probably the operational expenses, trying to save it by covering the mortgage. So that's actually what's happening. And the real issue is somebody's holding that paper. Somebody is holding the debt and the equity on that office building, whatever it is. It doesn't matter where it is. And that's the real issue, because if it's in the form of equity, it could be in a pension fund. It could be in a life insurance policy. It could be just a regular syndication of high net worth people. It could be a family office. It could be Goldman, it could be Blackstone, it could be whatever.
Yeah.
Somebody has those positions. That is the thing to watch.
And I think we're going to see that more and more as time goes on. And the prime performing properties are going to be able to weather the storm. Maybe cash flow is going to be taxed for a little bit, but the old phrase about when the tide goes out, you can see who was swimming without their bathing suit. That's going to be very true in this case. I do think that there is a silver lining in multifamily, which is even though not every operator, owner, or LP is going to get out unscathed, there is a basic human need served by apartments. Office, as we found out, although it has a great economic need, that's changed. People have been able to figure out how to work from home, and some prefer that. But I don't think anyone's going to be able to figure out how to live without a roof over their head for long.
Yeah, I agree. Well, office, retail, what people want their stuff. They want it today. They don't want it bricks and mortar. They don't want to go visit that anymore. So that's a little bit in trouble, not as much as office. And then also, I think you'll see it with hotels as well in a smaller way. The traveler hotel, just the people that are traveling during some kind of a recession. So those are the three asset classes, I think. Multifamily, to your point, is severely undersupplied. What I tell a lot of people is when interest rates go up on single family, it pushes people to rentals. And that's actually the message. When rates are low on single family, it actually, the single family developers, builders, home, anybody who's doing any of those deals, they're targeting the renters. To come, why rent when you can buy? So that's flipping. So that's why I think multifamily is really, really, really positioned and looking very, very good coming up, providing you're in a market that doesn't have a lot of policies around rent control and rent caps and stuff like that. So that's kind of the new big issue, the homelessness and all that the cities and counties are tackling.
This is the unique thing about real estate. Real estate's not like investing in a share of stock. If I buy stock in a company, every share is the same, with the possible exception of a preferred share or something like that, or a warrant. But with real estate, every property is different. I know you and Ross have always specialized and focused on markets that have had good tenant-landlord law in favor of the landlord, in places where there's good, robust jobs and so on. When we talked right after COVID, you were pleasantly surprised that there was a lot less of economic loss than you thought there might be. And so part of it is figuring out, are you in a market that makes sense for your product type, whether that's office, retail, hotel, or multifamily?
So as you can imagine, I started my career in Seattle, the Portland area. I did some stuff in California and Nevada and Arizona. And, we've had stuff in Idaho and Montana. And I'll tell you, so I still have a lot of network in those areas. And I have a very good friend of mine staying with me last week from Seattle, somebody I went to college with, actually. And he's still in the business at one of the bigger companies in the country. And he said, specifically the Seattle area, there's so much policy regulation coming down, rent, the defunding of the police and the safety issues and all that kind of stuff, that landlords are in big trouble. So not everywhere, but specifically in the downtown area. So I think, never before have we paid so much attention to our mayors and governors. And I think that's a really important thing moving forward that you're going to have to keep an eye on. And not to be political, not red or blue or anything like that. This has nothing to do with that. This has to do with private property rights. We're seeing big increases on property taxes. We're seeing big increases on insurance. We're seeing big increases on utilities. Okay, that's one thing, but we can't mitigate it if they cap us on the income. So, all of a sudden things are going the wrong direction. And I met with a good friend of mine who's going to be at Limitless, Clay Akawinzi, who's the head of capital markets for Berkadia, which of course is owned by Buffett. And I said, Clay, where's the money going? Because that's this is a very, very big, sophisticated company. And he said, right now we're being careful of deploying any money along the coasts. Now, he said, not necessarily Florida and some of the Carolinas, but certainly the West Coast and the East Coast, because of those things. And so when you have big managed money taking a look at if it should go somewhere, like, do I really want to invest in Portland when they're going to cap both sides. We're going to get the expense increases, and they're going to hedge the income. So Gresham's law, is basically good. The good money, it's going to go where it's treated best. Is the way I like to summarize Gresham's law, and so that's happening. That's going to happen with syndicators that you guys teach. That's going to happen with 1031 money. We're seeing people 1031ing out of California, Portland, Seattle, all markets that I know people in, and these are folks that I've grown up in the business with. They're looking for the places like Florida, Texas, Arizona, North Carolina, places that are a little more politically friendly, let's say. All of that's happening, and that's actually, unfortunately, just gonna make those markets that we're in, the areas like Texas or Arizona, be even better as people migrate out.
Our guest today is best-selling author Ken McElroy. When we come back, you'll have a chance to win one of Kenny's books, autographed by the author. We'll also tell you about an amazing event coming up later this year you're not going to want to miss. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hi, this is Garrett Sutton, Robert Kiyosaki's asset protection attorney and the author of Loopholes of Real Estate and Start Your Own Corporation. As an American or foreign-based investor in U.S. real estate, you know we are a litigious society. You know that you need to protect your real estate, paper, and bullion holdings with the right mix of LLCs and corporations. Our firm, Corporate Direct, not only forms these entities, but importantly, we properly maintain them too. If you fail to follow the corporate formalities, you can lose it all in an instant. Corporate Direct is your source for LLC protection and maintenance in all 50 states. Visit corporatedirect.com or call 800-600-1760. Mention the Real Estate Guys for a free bonus. That's 800-600-1760 or corporatedirect.com. We look forward to assisting you at corporatedirect.com.
As I speak, inflation is robbing you at a rate north of 10%. Last year, the number one zip code that Mid-South homebuyers offered income property to Real Estate Guys listeners in appreciated by 21%. To harness that spread and protect and grow your wealth in the current economic storm, you need the 2 decades of experience in renovation and management that Mid-South homebuyers brings to their investors. Every home Mid-South offers you will have brand new components, a new 30-year roof, and a high-quality renter, all in a price range under $150,000. Their empathetic property managers will use your ROI as their North Star, while the lack of repairs on their totally renovated properties contributes to their almost 4-year average renter stay and 99% occupancy rate. Learn about their lifetime occupancy guarantee and total 1-year maintenance guarantee by emailing midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. You'll be glad you did.
Hi, this is Dennis Waitley, and you're listening to the Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you ever wanted to do bigger deals like Ken McElroy, or you'd like to learn how to passively invest with other folks that are doing large deals, come on out to the Secrets of Successful Syndication. We do it twice a year. The next one in early October in Dallas, Texas. You can get all the details at the website at realestateguysradio.com. Under events, we're talking with Ken McElroy today about the current market concerns for real estate investors. And before we get back to the interview with Ken, it's time to give away one of his books. Yep, we're going to play real estate trivia. As soon as you hear the question and think you might know the answer, you're going to send us an email to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Give us your name, the answer to the question, and your physical mailing address, because the first person that gets it right gets an autographed copy of Kenny's latest book, The ABCs of Buying Rental Property. That can be yours if you know today's real estate trivia question. Last week on the program, we were talking about banking with Rick Rule, and we asked this: which country has the biggest banks? Specifically, of the top 50 banks by total assets and market capitalization in the world, which country has the most? Well, the answer is China, with 11 of the 50 biggest banks, followed by the US with 6, and France, Japan, and the UK, each with 5. Here's our real estate trivia question for this week. Which U.S. state has the highest rent? Yeah, Kenny's an apartment guy. We love rental real estate. Which U.S. state has the highest rent? You might know, or you can take a 1 out of 50 guess. Send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. First person that gets it right gets the ABCs of buying rental properties, signed by Ken McElroy. That's today's real estate trivia question. We're with the author of that great book and plenty of other books, our good friend Ken McElroy, and we're talking about what's happening in the financial markets, what that means to real estate investors. And Ken, you know, there's times where it's a buyer's market. There's times where it's a seller's market. And then within each of those markets, I think the key message is you have to exploit the differences between markets. One of the greatest things about real estate is no two properties are alike. And so focusing on some of the markets that make sense without changing who you are as an investor. Everyone knows you as the multifamily guy. I mean, you guys have been in apartments for a long, long time. What they may not know is you do ground-up development, you've done self-storage, you invest in all kinds of different things. With the changes that are happening right now, what do investors need to do so they can be as prepared as possible?
Well, thanks. There's a few things that we're doing, I'll tell you that. And so the first thing is you really need to build up your war chest of cash. That's the first thing. And, you know, I know plenty of people that have actually, they're even holding back on distributions right now. Now, it's the same thing that we did during the pandemic. We said, listen, guys, we have to do 90 days of no distributions. And we didn't have one pushback from any investor. He said, it's still your money. We have it, but we're going to hold on to it just because we don't know where this is heading. So I think that that kind of communication is probably something that you need to happen. If you have any properties that are teetering right now, and are suffering in any way from a tenant loss or high expenses or maybe even something on adjustment on the rate, you need to figure out how to get out of that deal or recapitalize it. So one way or another, that has to happen. You need to shore up all those little things that you probably didn't have to worry about when the economy was going really, really well. And then, you know, I think there's tremendous opportunity coming. There already is. We're already seeing some deals happen. You know, that just because there's a vacant office building does not mean that it's a bad deal. I had Pace Morby on my show yesterday on the podcast. He if you guys don't know him, he's one of the stars of Triple Digit Flip and has a big following on what's called Subject 2. And he's bought 3 multifamily deals for Subject 2 with no money down. Multifamily, by the way. And he's got one in Texas. He just got one in Springfield, Illinois. And you know, he actually did a whole thing on his YouTube about it. Wow. If you guys are interested in taking a look. But the point is, deals are still being done. And you know, the fundamentals are there. You know, there's no question that multifamily is going to have a very, very strong run here. The thing to pay attention to, and the thing that we're paying attention to, is I always tell people, you know, real estate does not exist without people, period. So people forget about that. Like, it doesn't work. You can have a piece of real estate, but if nobody wants to be there, go there, live near there, or there's no jobs around there, it's not going to work. So you have to be where people are going, or you have to be in markets that people want to be at. And there's a lot of reasons, you know, safety, weather, low cost of living, you know, all those kinds of things, family, work from home, that all that stuff plays into that. So study that, make sure that you go in the right places. If you take a look at the top states the last 2 years, Florida, Texas, North Carolina, Arizona, just to name a few, even Tennessee, So those are the markets where people are going. It's just people in, people out. That's the net number.
If you're not listening to Real Estate Strategies, your podcast, Ken, yeah, you need to do that. You guys have great guests. You're always talking about real world based situations. And I think the fact that you can draw on your years of practice. I love that when you illustrate a topic, you almost always have a story behind it because you've been in those situations. And that's the seat knowledge that we talked about. But at the same time, if you're new to real estate investing, I mean, it's a great time to get educated. There's so much happening in the financial markets. And, for the last several weeks, we've been talking broader picture economics because, we had George in the program talking about bank failures. We had Peter Schiff on the show, David Stockman, Rick Rule. I mean, these folks that are titans, but they aren't necessarily real estate folks because we can learn a lot from that. And I think that there's never been better access to information. You got to get around the right folks. Speaking of which, I do want to ask you about Limitless. So this is the big event you do every summer.
Yeah.
This will be the second annual Limitless. You're going to do it right after the Investor Summit. So Ken's going to be with us at our 21st annual Investor Summit in Belize.
Yeah.
And then we're all going to head to Phoenix for Limitless. Tell us about the event.
Sure. Well, first of all, I can't wait to come to your event in Belize. As you guys know, I've been many times. I don't even know how many.
I think this is your 11th or 12th year coming up.
Something like that. Yeah. So I always enjoy those a lot. You guys are, really, really do an incredible job putting those on. So looking forward to that again. Right after that, we, as you guys know, we're all confused as to what we should be doing and where we should be doing it and who should we be listening to and what moves we need to be making. And every year I find myself in the same spot. Like I listen to everybody, I try to devour books and YouTube videos and listen to anyone I can. But at the same token, I'm as confused as most people. I'm always trying to hone that in. And so one of the things that we put together Limitless last year, which is we have 40 speakers and it's not necessarily a real estate seminar.
Right.
Actually, there's going to be obviously some real estate folks there, but in maybe 40 different talks, maybe there's 3 or 4 of those. This is gold. We got Dana coming, gold and silver. We got Maselli coming to talk about oil and gas. We've got Chris Martinson coming, talking about energy. We've got all kinds of people coming to talk about lots of things. We've got Dennis Prager coming. We've got to talk about freedom and liberty. We got Joseph Wang, as you guys know, worked at the Fed. Chris Voss, my gosh.
Yeah.
Chris Voss, never split the difference. One of the top FBI negotiators, known as the number one in the world for negotiating. So these are people that I want to learn from. So selfishly, I tried to fill the room, both days with people I wanted to be around. So last year we sold out. This year, it looks like we're on track to do that again. And if people are interested, they can go to www.limitlessexpo.com, www.limitlessexpo.com. For your listeners, we've got a 20% off. They just type in Ken 20. Don't tell anyone. Ken 20, 20% off, and that's my own personal code for basically friends and family that I give out. It's going to be good. I'm glad you guys are coming, and there's a lot of uncertainty, and I think everyone's going to come in there with really an open mind. So,
well, just getting around other folks. I know the content from the stage is going to be incredible. You've got great speakers coming. Good friends of yours and ours are coming to share, but the attendees as well. You meet people at these events. It's one of the highlights of our Investor Summit. Yeah, we have amazing speakers, and that's always great because they can talk to each other on our panels and things, and that's incredible. But the folks that you meet that are serious enough about their future to get on a plane, get a hotel room, spend some money on a ticket, those are the kind of folks you want to be around. And I think that whole sense of community has never been more important than it is right now. When things are crazy and when people are more distrustful of Wall Street, more distrustful of the government, and more distrustful of the currency, you got to have trust somewhere, and I think it's with folks. So we appreciate you guys going through the tremendous effort it takes to put together a large event.
Yeah.
Can't wait to be there myself. It's going to be awesome. So we hope listeners will find their way. Hey, come to both if you can. Come to the Investor Summit. Lots of us are going to do that, and we're going to jump on a plane and head to Phoenix for Limitless. But if you can't do both, well, do one or the other.
If you want to meet the three of us, we will be at both.
There you go. That's right. All three of us will be at those events. And why would you miss it? Good stuff. Well, hey, Ken, as we wrap up here today, people get disheartened sometimes when they're worried and banks are failing and inflation is high. Just take us through your mindset when it comes to investing and continuing to keep your eye on the horizon and your motives clear. Yeah,
it's very, very difficult, in my opinion, to fight amongst everyone when next year's better than the current year. It was like a snowball, going downhill. It's just accumulating investors and syndicators. And when you see a line of people trying to bid on one project, then you're probably not going to get the best deal. The seller definitely has leverage. So for me, I'm super excited about the playing field actually starting to flatten a little bit, so that as a buyer, because I'm a professional real estate investor, I like to buy when the market's going up. I like to buy when it's going down. I never try to time it. I think that's a mistake a lot of people make. I always make sure that it just cash flows and that there's some incredible story around it.
Yep.
You can make money both ways. We've bought when the market's gone up and we've bought when the market's gone down. What we're seeing next is part of the process. I'm so excited about the next 2 years. We're just making little chess moves on the stuff that we own to make sure that we're safe. And that's actually just part of owning stuff. And then I'm building up a war chest of money and investors and people that, are going to see some of these opportunities. You really, really do make money when you buy. And I think people talk a lot about this, but I've been through 2 cycles. I'm telling you, this is going to sound crazy, but back when 05, 6, 7, 8 happened, as you guys know, I was buying apartments for $40,000, $50,000 a door. I still own them. I'm a long-term holder. And so, those same apartments are up over $200 a door.
Yep.
So ridiculous. Now it's all fake equity, and they'll probably come down again, but I'm waiting for that correction so that I can go in again and accumulate. And that's how you buy. I don't sell high. I buy low and I manage well and I keep refinancing and I hold. I don't buy low, sell high. Like a lot of people sell high. So, I think reality is starting to set in for people. And I think that's good.
I think it is as well. Well, we sure appreciate picking your big brain today. Look forward to seeing you on the Investor Summit and at Limitless. Thanks to Ken McElroy.
Good chatting with you guys as always.
You can learn more about what Ken does at kenmcelroy.com. You're tuned to the Real Estate Guys radio program. Back in a flash. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hear ye, hear ye. Registration is open for the Real Estate Guys 21st Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year is the editor of the Gold newsletter, Brian London, real estate developers Beth Clifford and Victor Menashe, and Jim Rohn's 18-year business partner, Kyle Wilson. Also back from Peak Prosperity, Dr. Chris Martinson, and the rebel capitalist, George Gammon. And joining us live and in person for his 11th Investor Summit, Ken McElroy. Plus 2 brand new faculty members we can't even mention yet. It all begins June 6th in beautiful Ambergris Caye, Belize. Visit Summit on Sand to get all the details and reserve your spot. This transformational week is like no conference you've ever attended. Go to summitonsand.com and make plans to spend a week with the Real Estate Guys, George Gammon, Ken McElroy, and an all-star faculty on the 21st Annual Investors Summit on Sand.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hey, it's Kyle Wilson, Jim Rohn's 18-year business partner, and you're listening to The Real Estate Guys.
And welcome back to the Real Estate Guys radio program. You picked a great week to listen, and we're glad you're here. Anytime I get to hear from Ken McElroy, it's a good day. My goodness, this guy's been through a ton and has lived to tell about it.
It's funny because I talk all the time about 2008 and the people that I sought out and I listened to. And Kenny actually was the guy behind the guy, because it was Kiyosaki who was warning us about real estate, but he was getting his intel from his advisor, Ken McElroy. And one of the things we learned from Ken was the importance of geographic selection based on regional factors specific to employment. Kenny said that real estate doesn't work without people. Maybe you could make the argument with agriculture or some type of mining type of real estate, but generally speaking, real estate, especially income producing real estate, is about demand generated by people who want to use that real estate to live in, to work in, to play on, to eat, entertain, whatever it is. So when he started talking about geographically linked jobs and why he was moving a big part of his focus in the 2008 financial crisis to Texas to focus on energy marketplaces, we thought, boy, that's brilliant. And then we ended up going into Memphis and Atlanta as distribution markets. Dallas is both a distribution and an energy market. Those turned out to be fantastic decisions. And that really came from just a little piece of intel that we got from Ken. So to your point, during the interview, Robert, Kenny just says these things, drops these little nuggets, you know. The one that we talked about, money going to where it's treated well. I mean, that's an old adage that I think everybody understands. And we try not to be political on the show, but the fact of the matter is policy matters. I mean, it really does matter. And especially when you start trying to battle inflation by capping landlords' ability to generate rental increases, you are writing a prescription for slums and no new development, which creates scarcity, which drives upward pressure on pricing. So now you have high-priced, crappy housing, and it's just because of people making those policies. I don't think they mean harm. I mean, you can go, oh, they're socialist. It doesn't matter. They don't understand the mechanics of what motivates capital to move. And so that was another brilliant comment Kenny made.
Yeah, you know, the exact opposite is what happens. And this happens all the time. It's like, remember when they wanted to make college more affordable and they introduced financing? What happened to college degrees? They went way up in cost just for the same reason that the car dealer asks you what you want to spend every month, not how much you want to pay for the car. So sometimes exactly the opposite happens. This is what I appreciate about Ken. He thinks through his position and he has the real world experience to back it up. I remember between 2009 and 2011, he and his partner Ross deployed around $300 million into real estate when the rest of the world was thinking, are you crazy? Now's the worst time to buy real estate. But a year ago, Ken and Ross might have been at the table with 10 other bids at best and final. In 2009 and 10, they were the only ones there. So they got better deals, but they had the fortitude and they understood the reasoning. So the big message today is to get educated. Clearly, you've made it this far into the podcast, so you're kind of already there. But don't be intimidated. As I've watched you, Russ, go from a guy that missed the mark, according to your own summary in 2008, to a guy that is self-educated and has figured this out. It's not that hard to do. one of the great tools we have for that, we've just launched. It's our monthly investor mentoring club, which is an idea that we did many years ago live in a room, and it now happens virtually so that all can attend. And the good news, our next guest, Kenny McElroy.
Yeah, in April, we had Tom Wheelwright, coincidentally on April 18th, which was the day that everybody had to file their taxes or their extension. And so we had Tom Wheelwright, who is Rich Dad Advisor for Taxes, come in as our guest and just coach us up. And it's live interactive. You get a chance to ask your question, so it's pretty exciting. Decided to bring Kenny in May 18th, so you can get information on that. It's a premium deal, so it costs money to be in the club, but we give you a free guest pass. So if you want to come check it out, just see what it's like, costs you nothing. Just send an email to rsvp@investormentoringclub.com, rsvp@investormentoringclub.com, and you can check it out and visit with Kenny, and he'll probably go into a little bit more depth. I mean, he said some things we don't have time to expand on. A couple of them, fake equity. What is that? We talk about that a lot because, we wrote the book, Equity Happens. We love equity, but we also know equity comes and equity goes. And if you want to build real wealth, you got to build real equity. And it's not the kind of equity that you think. And so we cover that in the program. And Kenny also talked about pruning. Being part of the growth process. He didn't use those words, but really that's what he was saying. So this is the time now, if you're feeling concerned about what's going on, if you're reading about the banks, you see inflation, you're concerned about interest rates, the stock market's been volatile, you don't know what to do. That's why we relaunched this program. Wall Street is going to give its advice. They're going to defend what they've done. They're going to talk their book. We don't sell real estate. We believe in real estate, and it's not just real estate we talk about. We talk about precious metals, the macro picture. We talk about private debt, private placements, talk about agriculture. We talk about energy, because it's all part of being a good investor. And to your point, Robert, I've learned and am now an advocate for Main Street education. I think your personal money is too important just to trust, quote unquote, professional advisors who are by and large, with respect, commission-paid salespeople. And so they're going to give you enough advice to get you to buy, and then that's the end of the story. And so I'm a big believer in you understanding fundamentally the basics. Just like you ought to know about your health, you got to know something about money and finance and investing, and that's what the club's all about. So RSVP@investormentoringclub.com. Get your free pass.
Big thanks to Kenny McElroy for sharing with us today. What do you do about all that? Well, next week we're going to talk specifically about due diligence and underwriting when it comes to real estate in today's economic climate. It's going to be a great show. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and Rich Dad Advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.